The final pieces of Australia's GDP puzzle will fall into place today. Falling job ads show a cooling Australian labour market, and we look at which state capital house prices are pulling away. That's coming up in our 5 Things in 5 Minutes. And then, in our bonus deep dive interview, ANZ senior economist Miles Workman digs into New Zealand's latest jobs data to highlight which sectors, regions and age groups are feeling the brunt of previous monetary policy tightening.
And I think the big picture here is these data are certainly weak. They show us that the jobs market is travelling south.
But first, in 5 and 5 with ANZ, global markets were quiet overnight due to the US Labor Day holiday. The US dollar and European stocks traded flat. The Australian dollar was up 0.4% at 67.93 US cents at 4 a.m. Sydney-Melbourne time, while the Kiwi was down 0.3% at 62.31 US cents. In Australia, the build-up to Wednesday's economic growth numbers continues today, with key export numbers as well as data on how government spending is driving activity. Here's ANZ senior economist Catherine Birch.
We're expecting that net exports will have contributed 0.8 percentage points to GDP growth in Q2 2024. We should also see a solid contribution from public demand in the government finance statistics today. And we've seen that strength, offsetting some of the weakness we've seen in the household sector and the private sector more broadly. Once we do get those final partials today, we will finalise our GDP forecast for the Wednesday release. But currently we're expecting GDP to have grown 0.2% for the quarter and 0.8% over the year.
Number 2. Another piece of the Australian GDP puzzle was business data yesterday. Catherine says growth in the salaries and wages of 0.7% between April and June was weaker than expected, as were company profits, which were down 5.3%.
In contrast to those weaker than expected results for wages and salaries and company profits, we actually saw inventories edge up 0.1% in the quarter. That was versus an expectation we had of a fall. So that means for GDP on Wednesday that we actually expect private non-farm inventories to detract 0.5 percentage points from Q2 GDP growth rather than the 0.9 percentage points we initially had penciled in.
Number 3. Looking at a more current indicator of the labour market, ANZ job ads, they dropped for the 7th month in a row in August. ANZ economist Maddie Dunk says the series reflects a gradual cooling in the jobs market.
You're seeing that in the downward movement in job ads, also in the lift that we've seen in the unemployment rate. So that supply-demand balance is moving closer to being back in check. If we look at the unemployment rate, it's been slowly moving upwards, and that reflects the fact that, yes, people are getting jobs, but we've also got a lot of people joining the labour force. So labour supply is going up and the pace of labour supply is outpacing demand at the moment.
Number 4. Australia's house prices rose 0.5% in August. That was the 19th monthly rise in a row. That's according to CoreLogic data. Maddie says the numbers reveal a split between Australia's capital cities, with Melbourne, Hobart, Darwin and Canberra seeing prices falling.
If you look at Perth, the dwelling stock just hasn't kept up with population growth. Adelaide, it's a bit of a narrower gap, but there is still really strong demand there at the moment. And one of the things that came out of the monthly data is that Melbourne dwelling prices are now lower than Perth and Adelaide. So Melbourne dwelling prices are the 3rd lowest across the capital cities. Now, part of that is because Melbourne has more units, so the metric is skewed, but nonetheless, it's showing you the momentum across some of those smaller capital cities.
Number 5. Activity in China's manufacturing sector, which many are pinning their hopes on to drive the economy, contracted for the 4th month in a row in August, although a slight rise in export orders was welcomed. ANZ senior China strategist Zhao Pangjing is expecting more economic policy support in coming weeks.
The big picture is the sluggish domestic factory activities dragged by the output price deflation. Output price sub-index dropped to 42. Factories had to pile up product inventory and cut employment at the same time. The good news is the gain in new export orders, which rose 0.2 percentage point. External demand remains driver for China growth.
Zhao Pangjing there. Now, in our bonus deep dive interview, ANZ senior economist Miles Workman analyses the state of New Zealand's labour market as the Reserve Bank starts to take the pressure off the economy with rate cuts.
I think the big thing to bear in mind with these data is that they are quite volatile on a month-on-month basis, and they are subject to revision as well. So what we actually saw with the July data is we saw the month itself come in at negative 0.1% month-on-month, but the prior months were actually revised to something a little bit weaker. So, we certainly can't rule out that we may see further revisions along that line going forward. And I think the big picture here is these data are certainly weak. They show us that the jobs market is travelling south, and that's particularly true when you take out the non-fiscal policy related sectors. So if you strip out, say, education, healthcare, public administration and safety, then primary goods, other goods producing industries, other services, they are certainly well into negative territory and travelling south. So certainly suggests that monetary tightening is working, but perhaps there's still just a little bit of residual fiscal stimulus flowing through the labour market right now as well.
Just looking at some of those sectors, I see construction jobs are down over 3% as well, retail trade down 2%.
Yes, well, what you're really seeing in these employment figures is a shadow of what we've already seen in the GDP data. So there does tend to be a little bit of a lag between the labour market and economic activity, and we know from the Q1 GDP data that the likes of construction, retail trade, wholesale trade, etc. are all very, very soft. The light at the end of the tunnel for these industries is clearly the easing in monetary conditions following the Reserve Bank's August MPS, where they cut the OCR 25 basis points and signalled that they're going to keep going along that path. So ultimately, yes, the economy and the jobs market is certainly doing what we in the RBNZ are forecasting it will do, and hopefully as monetary conditions ease, we will see eventually over, say 2025, these industries start to recover.
Just looking regionally, Auckland down the biggest number in terms nominally, nearly 7,000 jobs and down nearly 1%. But Wellington I see down 1.4% in terms of filled jobs from a year ago. Could that all be put down to the government's sort of tightening of the belt?
I wouldn't say it's all being put down to the government's belt tightening. Obviously, Wellington's impacted by the same monetary conditions as the rest of the economy. So Wellington has kind of been hit at it from two directions. One is the tight monetary conditions, which are weighing on households, weighing on businesses. But then on top of that, you do have the spending cuts, which will have an outsized impact on the Wellington region. So a bit of a double whammy or a double blow, unfortunately, for Wellington. And there's not a clear sign anywhere that things are going to turn around for that region in the very near term, but like the rest of the economy, there will be some alleviation in the pipeline there as easier monetary conditions provide some support.
Just looking at this by age group as well, a 13% drop, 12.8% drop annually in terms of filled jobs of 15 to 19-year-olds. Just walk us through that, why that's sort of a normal thing to happen at this part of a downward cycle.
Yeah, so this is quite typical business cycle dynamics. So your youth unemployment, which is basically your 15 to 19-year-olds, but also your 20 to 24-year-olds, they tend to be more at the pointy end of the labour market when it does deteriorate because they're less experienced. They have the option to also go and study. So what happens is when the labour market is offering less opportunity, you do tend to see those cohorts feel the brunt of it. So that's exactly what we're seeing. We saw that in the Q2 labour market statistics, and the data today suggests that that's a dynamic that's continuing to unfold into Q3, which is entirely what you would expect at this point in the business cycle and is definitely tough times for those youth workers.
Miles Workman there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, September the 3rd. Catch you tomorrow with what to expect from Australia's GDP data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.